Asset management companies, or AMCs, play a very important role in India's financial landscape. Their main job is to collect money from many investors. Then they invest this pooled money into different types of assets. These assets can include shares of companies, which are called stocks or equities. They can also invest in bonds, which are like loans given to governments or companies. Some AMCs also invest in gold or other commodities. Essentially, AMCs manage mutual funds. Their primary goal is always to grow the investor's money and generate good returns. They provide professional fund management services. This is especially helpful for people who don't have the time or the deep knowledge to manage their investments on their own. AMCs offer a wide range of investment schemes. These schemes are designed to suit different financial goals and how much risk an investor is comfortable taking, making investing easier for everyone. Efficient fund deployment is absolutely critical for any asset management company. Think about it this way. Money that is just sitting idle in a bank account doesn't earn much, if anything. For an AMC, quick and smart deployment of funds is key. As soon as money comes in from investors, it needs to be put to work by investing it into the chosen securities. This helps the fund achieve its stated objectives, like long-term growth or regular income. Any delay in deploying these funds can mean missing out on good investment opportunities. This, in turn, can lead to lower overall performance for the mutual fund scheme. The efficiency of fund deployment directly impacts the net asset value, or NAV, of the fund. And the NAV is what determines the value of an investor's holding. So proper deployment ensures that the capital is working hard right from the start, aligning perfectly with what investors expect when they put their trust and money into a fund. Just as deploying funds wisely is important, meticulous planning for outflows is equally vital. Outflows happen when investors decide to take their money out of a fund. This is called redemption. AMCs must always be prepared to meet these redemption requests from investors promptly and without any hassle. To do this, they need to have enough liquid cash available, or they need to hold assets that can be sold easily and quickly without a significant loss in value. If an AMC fails to meet redemption requests on time, it can cause a lot of worry among investors. It can also severely damage the AMC's reputation, which is built on trust. Good outflow planning prevents a situation where the fund doesn't have enough cash, known as a liquidity crunch. This ensures smooth transactions for investors who are exiting. This careful planning involves forecasting how many redemption requests might occur. It also means maintaining an appropriate level of liquidity, or cash buffer, without keeping too much cash idle, as that would reduce potential returns for the remaining investors. This entire complex process of managing money coming in, or inflows, and money going out, or outflows, requires incredible coordination. It's like a well-rehearsed orchestra where many different teams must work together seamlessly. Information needs to flow very quickly and, most importantly, accurately between these teams. Even small mistakes or delays can be quite costly. Such errors can affect not only the AMC's own financial health, but also the returns and confidence of its investors. Therefore, having robust systems in place and maintaining clear communication channels are absolutely foundational to successful AMC operations. This operational backbone is what ensures that every rupee of investor money is handled with the utmost care, professionalism, and efficiency. It covers the entire journey of the money, from the moment an investor decides to invest until the moment they decide to redeem their units, ensuring integrity throughout. The unit administration team is often the first point of contact for all investor-related transactions. In India, this function might be handled by an internal department within the AMC, or more commonly, outsourced to specialized entities known as registrar and transfer agents, or RTAs. Their primary responsibility is to meticulously track all the money coming into the fund. This includes lump sum investments from new investors and regular contributions through systematic investment plans, or SIPs. Simultaneously, they are responsible for processing redemption requests from investors who wish to withdraw their money. The accuracy of their records is paramount, as these records form the very basis for understanding the daily net fund flows. They ensure that every single rupee is accounted for, managing huge volumes of transaction data with precision and care. Fund managers are the investment experts within the asset management company. They are the ones who make the critical decisions about where the collected pool of money will be invested. Their decisions are always guided by the specific investment objective and strategy of each mutual fund scheme they manage. For example, an equity fund manager will look for promising stocks, while a debt fund manager will focus on bonds. They spend their days constantly analyzing market trends, economic indicators, and individual securities to make the best choices. Working closely with them is the fund accountant. This role is crucial for maintaining the financial integrity of the fund. The fund accountant is responsible for the accurate daily calculation of the net asset value, or NAV. They also record all investment transactions, track expenses, and prepare the financial reports for the fund, ensuring every dealing is properly documented and valued. The custodian is another key player, usually an independent financial institution, responsible for the safekeeping of the fund's securities. After the fund manager decides to buy stocks or bonds, these assets are held by the custodian, typically in electronic or dematerialized form. This separation of duties enhances investor protection. The custodian also plays a vital role in settling the trades executed by the fund manager, ensuring that the securities are delivered or received and payments are made or collected correctly. Distinct from the fund's assets, the AMC also has its own financial operations managed by its accounts team. This team handles the company's operational expenses, salaries, and other corporate financial matters. They may also be involved in verifying large fund movements and overall reconciliation processes, ensuring the AMC itself runs smoothly, while the fund's assets remain segregated and secure with the custodian. Several key data inputs are absolutely essential to drive these complex operations smoothly and accurately. One important document, especially for debt funds, is the lending sheet or deployment plan. This sheet details the available funds that can be lent out or invested in various debt instruments, along with potential opportunities. Another critical piece of information is the custodian inflow mail, or a similar report from the custodian. This serves as an official confirmation that the investor money, which was reported by the unit admin or RTA, has actually been credited into the fund's bank account. Finally, the funding sheet or call sheet is a very important consolidated report. It is often prepared by the unit administration team or a central operations unit. This sheet summarizes the total inflows from investors and the total outflows due to redemptions for the day, providing a clear net figure of funds available for investment or money that needs to be provisioned for payouts. The entire operational cycle kicks off when investors decide to put their money into a particular mutual fund scheme. This money, whether from a large one-time investment or a small systematic investment plan or SIP installment, flows into the designated bank account of that specific scheme. It is the unit administration team or the external registrar and transfer agent, or RTA, that meticulously records all these inflows. They collect application forms, verify details, and ensure that the money is allocated to the correct investor folio and the chosen scheme. They then generate initial reports that detail the gross inflow of funds received for that particular day. This initial stage of accurately capturing and mapping all investor applications and their corresponding monies is crucial before any further processing or investment action can be taken by other teams within the AMC. Once the unit admin team has compiled the inflow data, this information, often consolidated into the funding sheet and critically cross-verified with actual bank credits confirmed by the custodian inflow mail, is then swiftly communicated to the fund management team. The accuracy of this data at this stage is absolutely paramount. Any mismatch or discrepancy between the inflows reported by unit admin or RTA and the actual funds credited to the fund's bank account must be identified and reconciled immediately. The fund manager relies on this precise figure of net deployable funds to make well-informed investment decisions for the scheme. Even minor delays or errors in this critical data transmission can lead to inefficient cash management, such as leaving money idle, or worse, missing out on potentially lucrative investment opportunities that could benefit the fund and its unit holders. Armed with the accurate net inflow data for the day, the fund manager then proceeds to make decisions on how to invest these funds. These decisions are always made strictly in accordance with the specific investment mandate and strategy of the mutual fund scheme. For instance, if it's an equity growth fund, the manager might look to buy shares of companies they believe will grow in value. If it's a short-term debt fund, they might invest in money market instruments or short maturity bonds. These investment decisions are then passed on to a dealer or trading desk within the AMC for execution in the market. Once these trades are successfully executed, the fund accountant steps in to meticulously record these transactions, updating the fund's portfolio holdings and costs. Simultaneously, the custodian settles these trades in the market and updates their records of the securities now held by the fund, ensuring everything is correctly allocated and accounted for within the fund's book. At the same time as managing new investments, the system must efficiently handle outflow. When investors decide they want to withdraw their money, they submit redemption requests. The unit administration team or RTA processes these requests, verifies the investor's holdings, and calculates the redemption amount based on the applicable NAV. This outflow information is also a critical component of the daily funding sheet, clearly indicating the total amount of money that needs to be paid out to redeeming investors. The fund manager must ensure that there is sufficient liquidity within the fund to meet these redemption obligations promptly. This might involve using existing cash balances or, if necessary, selling some of the fund's investments to generate the required cash. Once liquidity is arranged, the fund accountant processes the payment entries, and the funds are then transferred from the scheme's bank account to the respective investors' bank accounts, thereby completing the outflow cycle smoothly and efficiently. Timeliness is an absolutely critical element in all asset management company operations. There are very strict, non-negotiable cut-off times for receiving investor applications for purchase or redemption of mutual fund units. The net asset value, or NAV, at which transactions are processed often depends on when the application and funds are received. Internally, the call sheet, which summarizes the net fund flows for the day, typically has a firm deadline for its submission to the fund manager. This ensures they have enough time to make prudent investment decisions. Furthermore, compliance with Fund Transfer Register or FTR norms, which dictate that funds are deployed or outflows are met within stipulated banking timelines, like T+1 or T+2 settlement cycles, is very closely monitored. Strict adherence to these internal and regulatory timelines ensures fair and equitable treatment for all investors, maintains operational efficiency, and actively prevents backlogs or processing errors. While there isn't one single, specific standalone regulation that minutely details every single internal step of this fund deployment and outflow provisioning process, the entire spectrum of AMC operations is comprehensively governed by the overarching guidelines laid down by the Securities and Exchange Board of India, or SEBI. These SEBI regulations are extensive and cover crucial areas such as robust investor protection mechanisms, principles of fair valuation for securities, accuracy in NAV computation and declaration, effective risk management practices, and timely, transparent disclosures to investors. AMCs are therefore expected, and indeed mandated, to establish strong internal controls, well-documented procedures, and consistently follow industry best practices. This ensures full compliance not just with the letter, but also with the spirit of these comprehensive SEBI mandates designed to safeguard investor interests in the mutual fund industry. The relentless pursuit of accuracy at every single stage of the process cannot be emphasized enough. It starts right from the beginning, capturing initial investor application data correctly, ensuring names, PAN numbers, and bank details are accurate. It extends to the precise execution of trades at the best possible prices, and the accurate calculation and disbursement of redemption amounts to investors. Meticulous record-keeping by the fund accounting team, diligent and careful processing of transactions by the unit administration or RTA teams, and thorough oversight and review by the fund management and compliance teams collectively work to prevent errors. This high level of accuracy is absolutely fundamental to maintaining correct net asset value calculations. The NAV directly impacts investor returns and is a key indicator of fund performance, thereby building and sustaining unwavering trust in the AMC's operational capabilities over the long term. In conclusion, the sophisticated and often complex choreography involved in fund deployment and outflow provisioning within an asset management company is a powerful testament to the critical importance of teamwork, precision, and robust processes. The efficient and careful handling of investor money, from the very moment it arrives at the AMC, through its strategic investment journey, and right up to its eventual redemption by the investor, is absolutely paramount. This well-oiled operational machinery, which is driven by clearly defined procedures, the timely flow of accurate data, and the dedication of multiple specialized teams working in concert, does much more than just ensure regulatory compliance. It directly and significantly benefits the investors. It maximizes the potential for their hard-earned investments to grow effectively and ensures they can access their funds reliably when needed, fostering a smooth, secure, and trustworthy investment experience for everyone involved in the mutual